I'd like us to explore the 4 basic financial statements that are used for external reporting with financial accounting. But before we do that, let's consider this concept. Every activity of a business entity, or really any organization, can be divided into these 3 categories right here: operating, investing, and financing. Let's take a look at financing first. Okay, pretend you have a brand new business. Let's say we're going to start a brand new restaurant. So we form the business entity, whether that's a corporation or an LLC or something like that, and that business entity owns nothing. It's like a baby coming into this world, penniless. So where is the business going to get its money? Well, could borrow money from a bank or another lender. That would be a financing activity. We could also obtain cash from investors who will then have shares of stock or percentages of membership interest for a limited liability company, but then they would have an ownership in our business. So financing activities explain how our company obtained cash, but not from customers, from external sources like lenders or investors. Now, continuing with the financing activities, as we repay the principal of debt, so money that we borrowed, that's going to be a financing activity, but that's cash leaving the business. And as we pay perhaps dividends to our shareholders, that's also a financing activity related to that relationship with the shareholders. So financing activities, you can think about it this way: borrowing money, repaying the loans, issuing shares of stock or other equity to owners, and then making repayments to them in the form of dividends or other distributions from the company. Now, continuing with this restaurant example, we obtain some cash. Let's say that we borrow some money from the bank and we issue some shares of stock, and both of those financing activities give us money. What are we going to do with the money? Well, eventually we want to run the restaurant, but we're going to need some equipment, right? And maybe a building or something like that. So the investing activities, these involve the purchase and sale of long-term assets. So we take some of this money that we obtained from the financing activities, and then we purchase an oven, some furniture. Maybe we buy the building. Okay, we could rent it, of course, but maybe we buy the building. These would all be long-term assets that we will use in the business for years to come. Those are investing activities. Investing activities could also involve the sale of long-term assets. Let's say that a few years down the road, we decide to sell the old oven and purchase a new oven for the restaurant. Well, the sale of the old oven is an investing activity that's actually going to bring cash to the organization because we're selling the asset. And then purchasing a new oven would be an investing activity where we use cash to purchase that long-term asset. Investing activities could also involve maybe buying stocks or bonds. What you typically think of as investing. Maybe you individually buy stocks, bonds, mutual funds. Businesses can do that, and that would fall in the investing category. Also, it's possible that we might loan money in the capacity as a lender to maybe another business or to just another entity. We could also put that in the investing category. That brings us to operating activities. Operating activities are the reason you're in business. With the restaurant example, that would be making food, selling it to customers. So making a sale to customers is an operating activity. Paying our employees, paying our suppliers, paying for insurance, paying for electricity to light the store, paying for natural gas to heat the ovens, and maybe climate control in the restaurant. Those are all operating activities. So think of operating activities as being the day-to-day activities of the business. Keep these in mind as we look at the 4 basic financial statements. Now, before we look at the financial statements, we do need to talk a little bit about vocabulary. And in my experience, I've been teaching financial accounting for 13 or 14 years at this point. Sometimes people struggle most with the vocabulary. So take a little bit of time in your studies to make sure that you understand some of the key terminology. Every account of a business can be divided into one of these 5 categories: assets, liabilities, owner's equity, revenues, and expenses. I want to point one thing out about owner's equity. A lot of times, and probably in your textbook, it's going to say shareholders' equity or stockholders' equity. And what that is, that's very specific to a corporation. But a corporation is not the only form of business that we can use for making our entity. It could be a limited liability company, in which case this would be called members' equity. It could be a partnership, where this would be partners' capital account. It could be a sole proprietorship, where we would call this proprietor's capital. So a lot of times I simply, I use a more general term, owner's equity, because that covers stockholders in a corporation, members in an LLC, and any other form of entity that we might choose. So as you take a look at these terms here, assets, I like to think about it as what the business owns. Okay? If you think about assets, more is typically better. More cash, more accounts receivable, which is what customers owe to us. More inventory within reason. Okay? Assets are the good things. Liabilities, those are what we owe to others. Maybe it's a loan to a bank, so we owe money to the bank. Could be something called accounts payable, where we owe money to our vendors. It could be something called accrued payroll, where we're looking at, we didn't pay our employees yet, but they worked for us. It's just payday is next week, so we actually have a liability to our employees in this example. Owner's equity is really, it falls into two main camps, okay? So you have contributed capital. That's the money or other resources that the owners have contributed to the business entity. Could be common stock, could be preferred stock, could be a membership interest if it's an LLC. But the takeaway is this: it's capital contributed to the business by the owners of the business. Now let's contrast that with retained earnings. Retained earnings is really owner's equity that comes from the profitable sales with customers. So we run our business, we conduct our operating activities, and if we do it right, we generate a profit. That profit will be retained within the business as owner's equity. As the business is more profitable, the business becomes more valuable because owner's equity will get bigger. Now, of course, you might want to take a distribution from the business. If it's a corporation, it'll be called a dividend. If it's another form of entity, it'll have different terminology, but the concept is the same, is that maybe some of those earnings are not going to be retained within the business, but we're going to distribute some of those to the owners of the business. That would be a reduction of owner's equity. Now, if we look at here, revenues and expenses, this is really your income statement here. Revenues are inflows from our customers. So we make a sale to our customers. Whether we sell them a product or we provide a service, we're going to measure the financial value of that product or that service, that item, that thing that we're selling to our customers, and we're going to call that revenues. Good things. Expenses, you guys have probably heard you have to spend money to make money. So expenses are outflows that we need to incur in order to generate revenues. What you're seeing here is we do have two major financial statements already listed here. What you have on the top here, this is essentially your balance sheet. And we're going to look at that in a little bit more detail in a few minutes. This right here is essentially your income statement. So we've got the balance sheet, which tells us what the business owns and what it owes. And the income statement really covers the results of the business's operations. The external reporting that happens with financial accounting involves four basic financial statements: balance sheet, income statement, statement of cash flows, and then some sort of statement of owner's equity. Again, I've generalized this because if it's a corporation, it would either be called a statement of retained earnings or a statement of changes in stockholders' equity or something like that. But I'm kind of generalizing it here. Let's take a look at each one of these financial statements. The balance sheet, as you might recall, explains what the business owns and what it owes. What you own, what you owe. we've got a coffee house here, and we have balance sheets for 2 separate years. Now, the first thing I want to point out is that the balance sheet really measures a point in time. This is not a period. This is not multiple days. This is a very specific point in time. In particular, December 31, 2018, and 2017. So what this is really measuring is what did this business own and what did it owe when the ball dropped on New Year's Eve at the end of 2018 and the end of 2017. Okay? That's a very important concept to understand, that the balance sheet covers this specific point in time. And as we look at it, I had promised you that assets, liabilities, and then the owner's equity would all kind of roll together on the balance sheet, and that's what we're seeing right here. Remember, assets are what the business owns. These are things that have a future economic benefit to the business. They're helpful to the business. Take the most basic asset, cash. At the end of 2017, we had $15,000 in the bank or in multiple bank accounts. And at the end of 2018, we had $22,000 in the bank. So we would look at this one particular asset. Cash is the most liquid asset, and we would say, oh, the business got a little bit more liquid from year to year, at least with respect to that one account. Then we look at accounts receivable. This measures amounts that our customers owe to us. In other words, we made a sale to them, but they didn't pay us yet. So it's not cash. Hopefully it will soon become cash. If it doesn't become cash soon, we need better customers. But it's still an asset. This is an economic resource of the business. Then we move down and we see inventory over here. Inventory, now this is a coffee house, so that's going to be stores of food, ingredients, things like that, maybe even napkins, plates, things that we will consume as we operate the business. In particular, things that we will consume and sell to our customers, okay? So it could be inventory of that nature. We could also see an asset here called supplies. Those are things that we would consume but then maybe use within the business. Then we've got this weird animal here, prepaid rent. What a weird concept. How is that of value to the business? Well, what we're seeing here, at the end of 2017, we had prepaid rent of $5,000. At the end of 2018, it was $6,000. Let's assume that the business's rent is $1,000 per month. That means that they had over here 5 months of rent prepaid, over here a half year of rent prepaid. In essence, they paid for some of their rent in advance. And we did not want all of that to be an expense on the income statement, which we're going to look at next. Instead, we keep it on the balance sheet because it does have future value. What this is telling you is this business would be able to occupy its space, whatever area it's renting, for the next 6 months without writing another rent check. Now, you can see here, this is a classified balance sheet, and we call these current assets. What that means is we expect those assets to either be cash or become cash or be used up, consumed within the next year or the operating cycle of the business if that happens to be longer. For most businesses, we're going to assume 1 year. There are certain industries where the operating cycle is longer than a year. Think about shipbuilding or building Boeing 737 airliners. Things like that might take longer than a year. But for most businesses, 12 months really covers it. So think about this as being within the next 12 months, these assets here are expected to become cash or be used up within those 12 months. Remember the future cash flows, right? The amount of future cash flows, the timing, and then the likelihood. If we think back to those fundamentals, well, we have the amounts here. As far as likelihood, we'll talk about that in a different lecture. But think about the timing here. What this is telling us is that within the next 12 months, we expect these assets to become cash or to be used up, to be gone. These assets down here, longer than 12 months, okay? We would say this is going to be sometime beyond, the 1 year period. Equipment. These are the ovens and the stoves and the furniture and things like that. These are the investing activities that are showing up on the balance sheet. These are assets. They're benefit to the company. The company can use these assets to run its business, but we don't expect them to be converted to cash within the next year or used up within the next year. We expect to have these for a while. In fact, if you were to convert these to cash, that might not be a great thing for the business because eventually you wouldn't have anything available to be able to run the business. Now, then we have total assets. Now, the reason this is called a balance sheet is because if we add up all the assets here, that is going to be equal to the liabilities and the owner's equity combined. See if I can do a better circle on that for you guys. Okay, and that's a fundamental thing. We're going to talk about this in a little bit more detail later, but the fundamental accounting equation, assets equal liabilities plus owner's equity. Because down here with the liabilities, what's happening here, these are things that we owe. Accounts payable means that we purchased some things from a supplier or suppliers, and we owe them money. We did not pay for it yet. Accounts payable is really the counterpart to accounts receivable. With accounts receivable, customers owe us. With accounts payable, we owe our vendors or suppliers. And on their books, our account payable would be an account receivable on their books. Then we have some other kind of short-term payables here. Maybe we owe our employees a little money. We owe some interest on the bank loan. Sales tax. We collect sales tax from our customers, and we actually have to remit that to the state government. And that's a short-term liability where we're just kind of holding the state's money for a little bit. So go back to that timing. All these current liabilities, we expect to have to pay these within 12 months. So do you see how the balance sheet is starting to paint a picture of future cash flows? These are the amounts here that we expect to convert to cash or use up within the next year. These are the amounts that we expect to have to pay within the next year. And you can start to make some assessments about the health of the business in the short term. Current assets are $91,000. Current liabilities are $51,000. That is one metric that paints a favorable picture of liquidity or short-term health of the business. Because really, our current assets are almost double what our current liabilities are. That's a good thing. Now, certainly some liabilities could be non-current, and these are going to be beyond 12 months. For example, a bank loan that we have here. It's a note payable. We're going to be making some payments on that over the course of time. I don't know if that's 5 years or 10 years or whatever, but just think about your own mortgage and see how this information in the classified balance sheet helps us assess the future cash flows, because we know that we have to come up with this money for these current liabilities within the next 12 months. But these liabilities, we know that we have a little bit longer. Now, there will be disclosure notes at the end of the financial statements that will give us even more context regarding that long-term note payable, like the term and the monthly payments and things like that. But at the core, as we just kind of look at the face of the balance sheet, we can see that this is going to be owed at some point in the future. And then finally, we have owner's equity. In this case, it is a corporation, so we're going to call it stockholders' equity. This common stock is contributed capital. In other words, the stockholders of the company contributed $30,000 in exchange for shares of the company. The retained earnings, and if we just kind of look at the end of 2000, my circle's not the best, but you guys can probably make it out there. At the end of 2018 was $256,000. What that tells us is that the business has operated and generated a profit in past years. And that's the amount of the accumulated profit that has been generated by the business since its inception that has not been taken out by the owners in the form of a dividend, in this case with a corporation. So the balance sheet really tells you what you own and what you owe at a point in time. So the balance sheet covers a point in time, but the income statement covers a period of time. The income statement is really measuring the results of our company's operations. And it's important to designate what is the period of time being covered. In this case, what we're seeing is it's measuring the entire year of 2018 here, the entire year of 2017 here. And it's important to be specific. It would not be good enough to say for the periods ended December 31, such and such year, because that could just be the month of December. It could be the last quarter of each year. It's not specific enough. But we know here we're seeing the results of an entire year's operations for 2018 and entire year's operations for 2017. And the income statement can have different versions. There's a single step, there's a multi-step income statement. What I'm showing you here is a multi-step income statement. They both get to the same bottom line net income. You can think of net income as being profit. Okay? But the multi-step income statement has a few subtotals along the way to give the users a little bit more granular information. Let's take a look kind of line by line here. So we've got total revenue. This first category, these are inflows from our customers. So we're running a coffee house and we choose to disaggregate that revenue into beverage sales and food sales. There's really no requirement that we do that. What we want to do is we want to disaggregate it to a level that's meaningful to the people who are reading the financial statements. And apparently we've chosen these two categories. And it's not that we couldn't have others. Maybe we have a catering revenue category or merchandise revenue. Sometimes a coffee house will have t-shirts or coffee mugs or things like that. But we've kept it simple here. So these are the sales revenues earned from transactions with the customers. Now, you have to spend money to make money. And for a restaurant, cost of goods sold is going to be a pretty fundamental total for us there. So in other words, what did we pay for ingredients to make the coffee and to make various food products or whatever? I think about cost of goods sold as being very closely related to the revenues. In other words, you're not going to be able to generate revenues if you don't have this cost of goods sold. You're not going to be able to brew a cup of coffee if you don't have coffee beans. So that's the first major subtotal. And sometimes what can confuse people is we don't see any real minus signs here until we get down to the bottom. It's just generally understood that if you're reading an income statement, you're going to subtract an expense to arrive at whatever next subtotal. 627,000 minus 123,000 gives us a gross profit of 504,000. We don't put a minus sign there, it's just understood. And the same thing is true here, our operating expenses. These all reduce our profit or net income, but we don't depict them with a minus sign. It's just generally understood that expenses cause your profit to shrink. That's why businesses want to control their profits, obviously. Now, when we get down here to operating income, what we're really measuring here is this is the results of our day-to-day operations. This is the financial impact of the reason that we're in business. There might be other things that would impact our profit. Maybe miscellaneous income or interest expense or miscellaneous expense, or maybe the gain or loss because we sold an old oven or something like that. Those would kind of be down here, not really part of our day-to-day operations because it might be different next year. We may not even have this miscellaneous income in a future year. So we just kind of group them down here into other. And that's where we do get a little bit, these parentheses mean that this is a negative item. And the reason we're putting parentheses there is simply because everything in this category could go either way. It could be something that causes income to be larger, like miscellaneous income, or it could be something that makes our net profit smaller, like interest expense. So in this case, we do denote the expense with a parentheses or negative, just because it's causing our profit to get lower. But what you're seeing is this. At our restaurant for 2018, we generated a profit of $243,000. The previous year was $245,000, and that's really giving us the results of our operations for that time period. So we've explored the balance sheet and the income statement. Now we move to owner's equity. Now, as I had mentioned before, I generalize it because a business could be any number of different entities. Could be a corporation, could be a limited liability company. In this case, we are dealing with a corporation, which means that we have two broad categories for owner's equity. Some kind of contributed capital like common stock, and then you also have retained earnings. So common stock means that what's signified by that account is the owners have contributed capital, most likely cash, but it could be other assets. So let's assume they contribute cash, and then what they get in exchange for that is an ownership interest in the business entity. So that's contributed capital, contributed by the owners. Retained earnings is the result of running a profitable business and then having the business entity retain those earnings within the corporation. Earnings is a synonym for profits. So if we generate a profit, we've generated earnings. So when it comes to reporting owner's equity, what we're really doing is we're explaining how the owner's equity changed from one year to the next year, from one balance sheet date to the next balance sheet date. Now, in this case, retained earnings was the only owner's equity account that changed from year to year. If I go back and look at this balance sheet, you can see that common stock was the same at 2017 as the end of 2018. Retained earnings, however, increased from 248 to 256. So when we get to the owner's equity statement, we're just going to explain what happened to retained earnings. There's really no value in saying that common stock stayed the same. If common stock had changed, then we would have a broader, expanded statement, probably called a statement of changes in owner's equity. And it would explain the changes in both common stock and retained earnings. But let's keep it simple. So retained earnings started the year 2017 at $206,000. That also means that was the balance at 12/31/2016. So if you had looked at the balance sheet at the end of 2016, this is what would have been reported for retained earnings. The balance at the end of 2016 is identical to the balance at the beginning of 2017. And then we run the business for a year, and we generated a profit of $245,000. That would be reported on the income statement. Now, if we had not taken any dividends, what would happen is the beginning balance of retained earnings would simply increase by the amount of net income or earnings that were generated during that year. So it would go up to, what is that, $451,000. However, we paid distributions to the owners. In a corporation, it's called a dividend. So we deduct that from retained earnings. Because we paid this dividend to the owners, some of the earnings have not been retained in the business. Now, if this concept of retained earnings is confusing to you, I think that makes you normal at this stage of the game. It's an odd concept because retained earnings is not cash, it's not equipment, it's not any particular asset. It's really just this equity that's been generated because the business has been run in a profitable manner. Think about it this way. We run the business, we generate a profit, and a profitable business is going to be worth more than a company that does not generate a profit. So the fact that we're generating this profit here in 2017 and 2018, that makes the business more valuable. That's the concept of the retained earnings, owner's equity getting bigger because of these earnings we've generated. Then, to the extent that we distribute some of those earnings to the shareholders, we treat those as a reduction of retained earnings. We're going to look at that statement in a little bit more detail in a few minutes, but let's turn the page and look at the statement of cash flows next. We've seen the income statement, the balance sheet. We looked at the statement of retained earnings, which is owner's equity. The fourth major external financial statement is the statement of cash flows. And this will be clearer as we progress in our study of financial accounting. In particular, we're going to talk about this in a few minutes. There's this concept of accrual accounting. And what that basically means, at least at this stage of the game, is that we might measure things on the income statement before or after they actually appear in our company's cash accounts. Okay? Like I say, more details on that in a few minutes. But because of that, the income statement does not necessarily measure what has happened to our cash account, to our checkbook, if you will, because of this concept of accrual accounting. That's where the statement of cash flows comes in. Statement of cash flows is fundamentally important for explaining where did a company obtain its cash and where did it spend its cash? What were the uses of cash? Now, remember those three basic activities: operating, investing, and financing. The statement of cash flows is divided into those three categories. In this particular example, I did not include an investing section. And I did that simply to keep it simple and to make it fit onto one slide right here. Most businesses would have an investing section that would be right in here in between operating and financing. And the investing section would depict purchasing long-term assets, selling long-term assets. But let's just pretend that this is an established business. They did not have the need to buy any furniture or new equipment or anything like that. And they also did not sell any long-term assets. So we're just kind of skipping the investing section. As we progress in our studies later in the semester, you'll see plenty of examples where we have an investing section in the statement of cash flows. So here we have operating and financing activities. Now, there are two different ways of preparing the statement of cash flows. There's a direct method and there's the indirect method. And we'll explore those in more detail as the semester goes on. The method you're seeing here today is indirect method. And what that basically means is we start with our net income that came from the income statement, and then we make some adjustments to net income. Things that influenced net income but did not affect cash. For example, there's this odd concept called depreciation, where we take our long-term assets and we I won't say get rid of, but we reduce the asset on the balance sheet systematically over time by converting it to an expense. Now, depreciation expense does make our net income lower on the income statement, but it does not affect cash. We don't need to spend cash to incur this expense. So we actually add this expense back to net income. Then we get to some of our changes in current assets and current liabilities. And I'm not going to go into the rules for whether you add or subtract at this point. That's a different lecture for when we're in class together. We'll explore that in more detail. But I'll give you an overview. But basically this is these are things that impacted the income statement but did not impact cash. So we have to adjust for those effects. At the end of the day, what we have here is this is the cash provided by operating our business, our operating activities. And you might start to see that it's fundamentally important to have a positive operating cash flow, at least in the long term. Sure, you could have a year or two where your operating cash flow was negative, especially maybe if you're in a growth mode or something like that, or early stage of the business. But that wouldn't work in the long term. In the long term, you need to have positive operating cash flow. Because remember, the operating activities, those are the day-to-day activities. That's the reason we're in business. And if you cannot generate cash for the primary reason you're in business, you're either in the wrong business or you need to learn how to run that business in a better manner, right? So we're looking for positive here. Now, the financing activities, that could be we're borrowing money from a bank or from another lender, and that would be a cash inflow. It could be that we are issuing common stock or other owner's equity. That's a cash inflow. But in this case, we don't have any inflows in this category because we're running a profitable business. So what we're doing here is we've got cash leaving the organization, repaying debt, the principal portion, and paying dividends to our owners. You might remember we had those dividend payments that were on the statement of retained earnings. They're right here as well. So what we're seeing with this business is we provided cash because of our operations, which is great, and we're using a big chunk of that cash to repay some long-term debt and to provide a return to our owners in the form of dividends. So we see that operating cash flow, for example, in this case, is $248,000 positive, and then the financing activities used $241,000. That means that our cash balance increased by $7,000 from the beginning of the year to the end of the year. And that explains how our cash balance at the beginning of the year went from $15,000 to an ending balance here of $22,000. We'll look at those relationships in a few minutes, but understand that a lot of financial statement users, they look to the statement of cash flows to get insights regarding this lifeblood of the organization. An organization cannot survive without cash. You need cash to pay your employees, to pay your suppliers, to pay your rent, all those types of things. So this is such a critical statement to bring everything together. And when used with the income statement and the balance sheet and owner's equity, all those statements in concert really help us get a picture of what's happened in the past with a company, and then help us also assess those future cash flows. How much, when, and how likely. These are the same financial statements that we've been exploring for the past few minutes, but I want to show you some of the relationships that exist. So I like to think about retained earnings as really being the keystone of the financial statements. And here's why. I've got an excerpt of the income statement. I shortened it, but you can see the revenues and then the bottom line net income, and an excerpt of the balance sheets as well. And again, I cut out some of the middle portion here, but you can see the total liabilities and stockholders' equity over here, the very end of the balance sheet. Now, what I'd like to point out is this. Look at the balance in retained earnings at the end of 2017, $248,000. That matches up right here with the balance in retained earnings on the balance sheet at the end of 2017. This is why I think retained earnings is really the keystone of the financial statements. Remember that the balance sheet has to balance. The assets need to equal the total of liabilities and stockholders' equity. I'll just put that up here as a reminder. Assets equal liabilities plus stockholders' equity. That's basically the balance sheet in the form of an equation. So how does this tie together? Well, look at the net income from the income statement from running our business for the year 2017. That net income is a component of retained earnings. Retained earnings began the year $206,000. Then we ran the business, generated a profit of $245,000. That caused our retained earnings to increase. Then we paid those dividends to the shareholders, which caused the retained earnings balance to decrease, ultimately ending at this balance right here, the $248,000. So the retained earnings ties the income statement with the balance sheet. And we'll see in a minute, it also ties in with the cash flows, because the statement of cash flows has some relationships we need to explore as well. This is the same shortened version of the income statement and shortened version of the balance sheets that we looked at just a moment ago. And what I wanted to do is explain how the statement of cash flows ties into these two statements. I should point this out too. The statement of cash flows covers a period of time, just like the income statement. In fact, the only financial statement of the four that is a point in time is the balance sheet, right? Remember, this is what we own and what we owe right at the end of 2018, right at the end of 2017. But all the other statements, the income statement covers a whole year in this case, statement of cash flows covers the same year. The owner's equity statement, the retained earnings, covered also the entire year. So the income statement, cash flows, and owner's equity, those are change statements that cover a period of time. Balance sheet is a point in time. And actually what we're going to do here is we're going to prove this cash balance, because at this point in time, our cash balance was $15,000 at the end of 2017. And you're seeing that right here at the end of the statement of cash flows. At the end of 2017, we had $15,000 in the bank. And guess what? That is going to be the same as the beginning cash for 2018. So ending 2017, we had $15,000. We better begin the next year with that same $15,000. Now the question is this: how did we get from $15,000 at the beginning of 2018 to $22,000 at the end of 2018? The balance sheet tells us where we got. We got from 15, we got over to 22,000, and that's great. But how did we get there? That's where the statement of cash flows comes into play. So the statement of cash flows, at least in the indirect method here, starts with what was our profit for the year. So our net income for 2018 was $243,000, and that's the starting point. And then we go through the various increases and decreases that we will go into in much more detail later in person when we meet. But at the end of the day, the change in cash during 2018 was cash went up by $7,000, and that explains how cash went from 15 to 22. So the statement of cash flows really ties together what's happening in the income statement and what's happening elsewhere in the financials to explain why the cash balance went from one point in time to a different point in time.